Good morning, good afternoon, good evening, wherever this may find you around the world today. I know we have many people around the world who take in this webinar, some of them live and some of them on demand. Glad to have you with us today as we talk about this crop report. And frankly, there were not a lot of changes in this crop report. I will talk about those changes, but it also gives us an opportunity to talk about a number of other factors at play in the marketplace, including the U.S. election. And I'll be spending some time talking about what I see as impacts of the election on the grain and oilseed markets as we go forward. So now, as we look at this, price is still a function of supply and demand, but is modified by the flow of money. So we're going to start off with looking at the broader economy. We do not yet have the October inflation data. That will be released soon, I believe, next week. So the latest that we have available is September data, where we saw the headline inflation number drop to 2.4%, with the core actually ticking higher now to 3.3%. And so the Federal Reserve met yesterday, actually the previous 2 days, and decided to go ahead and nothing changed. It said the election doesn't change anything. We had a very bad jobs report on the 1st of November, just 12,000 jobs created. Some of that was due to the 2 major hurricanes that had hit the Southeast, disrupting the job market. But there were some other troublesome things in there as well. The previous 2 months prior to the hurricane were adjusted downward by 120,000 numbers. In fact, I think August job creation number was cut roughly in half. So there are some problems. Many of those are in the manufacturing sector. We've received quite a bit of data over the last couple of weeks showing that the service sector is really hot right now and growing strong. Manufacturing sector is hurting. Now, we've also seen industry surveys that have shown that many firms were simply waiting for the elections to make decisions on hiring and expansion. So I'm really anxious to see what the jobs report looks like the next couple months. Obviously, hurricane recovery is going to impact. If you're a business that was wiped away, that you're not going to recover very quickly. But for other businesses, see if it recover. But how many firms now start expanding and hiring people based on the expectation that a Trump administration is going to mean tax cuts or keeping the current tax cuts, not letting them expire next year, as was going to be the case under the Harris administration, and deregulation in a more favorable business environment. And so that's what I'm going to be anxious to follow here over the next few months to see if we see some changes for all of that. We also saw some consumer report data showing a pop in consumer sentiment, consumer confidence ahead of the elections. And that means increased spending. In fact, some of the data showed that we have seen increased consumer spending as that confidence is going up. So you have to be very careful about getting aggressive in cutting interest rates in that environment. So the Fed decided to just stay the course for this meeting and then assess things next time. But that's where we're at right now as we look at overall the inflation picture. But the Fed is focused on jobs. And for some reason, they've put 4.3% as their cap. We can't let it go over that, and they'll stimulate if we do. I'm not sure that's very wise right now, particularly in historically the normal inflation rate was at least a point to a point and a half above that. Now, as we look at where the inflation was on the left, we see the month-on-month changes. The big increases were in apparel and airline fares, but also fruits, vegetables, motor vehicle insurance. That's been a big one overall. Meats, protein sector, medical care services, et cetera. And you see how offset that was by major declines at the bottom of that graphic due to fuel and oil. If we look down here, dropping 4.2% roughly and 5% respectively. Now, year on year, motor vehicle insurance has been a big cause of service sector inflation, and the Fed has very little impact on that. That's largely a policy issue in many states not prosecuting car thefts or having cashless bail programs. and that's raising insurance costs for all of us. And that's been a major inflation problem. Tobacco and smoking products, another big one. Motor vehicle maintenance and repairs going up. Uh, Rent and primary residences has been strong. And I think that's going to be staying strong here as consumer confidence goes up. Perhaps rents coming down, but home ownership, home prices going up. Now, that has been largely countered by energy prices. What happens if those energy prices start going back up? Anyway, let's just keep that. I'm not predicting that right now on the energy prices, but let's move forward. Monetary base. And I've talked to you before how we're trending higher, even though the Fed is shrinking the balance sheet. And that's largely due to fiscal stimulus that we see in the economy that's keeping that money supply in the economy sufficient to support economic activity. Stronger in the services sector, weaker in manufacturing. Manufacturing, though, waiting to see who would win the election with a Trump victory, more business-friendly environment. Will that make a difference going forward? That's going to be one of the things we're going to have to watch. As we look at GDP growth, the third quarter, 2.8%, fairly healthy economy. Is it as robust as we'd like? No, but neither is it recessionary by any means. Recession, here we see the 2% or the 0% level. We drop below that for 2 quarters. That's a recession by definition. Unemployment rate of 4.1% now for the second month in a row. That's historically low. If we look at layoffs, at historically low levels, employers hanging on to employees. And in fact, they've been mentioning in industry surveys that as attrition removes employees from the ranks, whether it be due to retirement or whatever, they're having trouble finding replacements for employees to fill those vacancies. And so wage growth is starting to creep higher once again. Wage inflation. Now, unemployment rate has been overall trending, even though I showed you the last few months trending lower, essentially, but had been trending higher in the longer term picture because we're seeing a strong push toward immigration into the country and a very rapid pace of processing immigrants. And so that's increasing the workforce. Immigration is up 5.6 million people since the pandemic. And so as you increase the number of workers available, without changing the number of jobs available, you're going to increase the unemployment percentage. Now we look at household balance sheets. How healthy are they? Well, they're pretty strong right now in the United States and in Australia. When you look at Canada, though, in Australia, much weaker relative to us. So as we look at the percent of household balance sheets that are in excellent shape overall here, pretty good shape overall. Now, let's look at bankruptcy filings. There had been in 2023 a lot of stories about how bankruptcy filings were on the way up, but now the trend is back down once again, indicating some health there in that sector. Credit card debt. I remember seeing, of course, stimulus checks. A lot of credit cards got paid off here with stimulus checks. And then there was a lot of stories how we were increasing credit card debt. That is really flattened out right now and actually taken a slight turn down. If we look at corporate profits, they're near all-time highs. So relatively healthy economy. There are problem areas. I mentioned the manufacturing sector is certainly one of those. The housing sector has been one, although I do see some signs of optimism in the housing numbers of late. The share of Russell 2000 companies with negative earnings, this is one of the areas where we are seeing some problems starting to show up. Now, switch pages a little bit, our national debt. I went to update this page for this, and they'd done something with their website because they got some big announcement coming up that made it difficult for me to get a screenshot with the pictures I want. But really, we're on the cusp now of $36 trillion in national debt. And so if we look at interest paid on debt on an annual basis, this graphic here shows it's $974 billion per year, which is bad enough. But the Treasury Department has confirmed that that number in reality is now topped $1 trillion. And so